All right, welcome back to the Noob Selling Options channel, everyone. Today, we've got an incredibly fascinating explainer for you on what might just be the absolute most extreme market disconnect we've seen all year. We're going deep into the asymmetric setup currently unfolding for EchoStar, trading under the ticker symbol SATS. If you're the kind of person who loves discovering massive valuation inefficiencies hidden right in plain sight, you are absolutely gonna love the mechanics on this one. So, here is the $1 million, or actually the $49 billion question. Why in the world is a stock mathematically backed by $49 billion in pristine assets, trading like it is literally on the brink of absolute disaster? For the longest time, the market narrative has just been dominated by this very specific fear of a looming bankruptcy. But as we parse through the latest developments together, we're going to see that the underlying reality of EchoStar's balance sheet has completely, totally detached from market sentiment. Here's our roadmap to unpack this. Number 1, the asymmetric setup. Number 2, the balance sheet transformation. Number 3, the valuation arbitrage math. Number 4, the structural short squeeze. And finally, number 5, 3 phases of targets. Let's get right into it. Okay, let's dive into section 1, the asymmetric setup, and specifically smashing that $2.9 billion FCC overhang. For a solid decade, EchoStar has had this dark cloud just hovering over them. We're talking about a $2.9 billion shortfall liability stemming from an AWS-3 spectrum license dispute. Basically, this was an argument over the rights to highly valuable cellular radio frequencies way back in 2015. For the bears, this was the ultimate trump card, right? A looming bankruptcy death sentence. But here is the critical shift. EchoStar struck a settlement clause with the FCC. They agreed that if the re-auction of those licenses, which was Auction 113, kicking off in June 2026, raised $2.9 billion or more, EchoStar's liability would instantly drop to exactly zero. Well, the bidding aggressively accelerated, gross proceeds officially crossed $3.1 billion. And just like that, bam, the entire $2.9 billion liability vanished into thin air. The bears' core bankruptcy argument has been totally wiped out. Moving right along to Section 2. The balance sheet transformation, from network builder to spectrum fortress. $19.6 billion. That is a staggering number. This represents the groundbreaking deal where EchoStar offloaded a huge chunk of its AWS-4 and H-Block spectrum directly to SpaceX. And not only did they get tremendous value for this, but the deal secured EchoStar roughly 52 million shares of SpaceX Class A common stock. Plus, and this is huge, it included $2 billion in interim debt service coverage, carrying them all the way through late 2027. This single move dramatically shifts their entire financial footing. But they didn't stop there. Enter another massive figure, $22.65 billion. EchoStar went ahead and finalized another massive spectrum sale, but this time it was a pure cash deal with AT&T. This $22.65 billion cash influx is explicitly being routed to wipe out their remaining legacy Dish debt tranches. They are systematically cleaning house and removing literally every layer of financial distress from the equation. Now, what's really interesting about this is when you actually sit down and tally the raw math of these moving parts, the picture becomes incredibly clear. First, you've got those 52 million SpaceX shares, marked at a post-IPO value of around $200 each. That gives us $10.4 billion. Add the guaranteed $22.65 billion cash inflow from AT&T. Then, remember, even after these historic offloads, EchoStar still holds a pristine, unmonetized stockpile of low and mid-band spectrum, conservatively valued at a baseline of $16 billion. And finally, that FCC shortfall liability, settled, sitting right at zero. You add all that up, and you get a staggering gross sovereign asset value of $49.05 billion. Let's look at Section 3, the valuation arbitrage math, the pricing disconnect. The market is currently, drastically inefficient. I mean, EchoStar is pricing around $121 a share, practically acting as if its assets are illiquid or just nearing worthlessness. But let's take that $49.05 billion asset backing we just calculated and divide it across EchoStar's roughly 289.8 million total outstanding shares. That pure math pushes the true net asset value, the NAV, to between $170 and well over $230 per share. Even if you apply a strict institutional holding company discount, the fair value still sits comfortably above $155. The contrast here is just stark. The market is pricing in a reality that, quite frankly, no longer exists. Which brings us to Section 4, the structural short squeeze, the tightening bear trap. This setup is practically primed for a massive structural squeeze because the bearish consensus is currently trapped on the wrong side of the news. We have extreme short interest here. Shorts are crowding into EchoStar, holding 40.6 million shares short. That represents roughly 31% of the tradable float. Furthermore, this isn't a stock with a lot of loose shares bouncing around, right? The tradable float is incredibly tightly held by insiders and institutional SpaceX proxy buyers. So the crucial point is this massive liquidity choke point, 8.9 days to cover. Because the float is so tightly restricted, if all those short sellers suddenly wanted to buy back their shares to exit their positions at the average daily volume, it would take them nearly 9 full days. It's the financial equivalent of trying to push a whale through a garden hose. There's quite literally no physical way for the shorts to exit quickly through a door this narrow. And this brilliantly illustrates the mechanical urgency of what happens next. It's a dangerous loop known as a gamma cascade. It works in 3 distinct steps. Step 1, there's massive open interest in near-term call options, specifically in the $115 to $130 strikes. As the underlying stock price naturally drifts up towards its fair value, these calls start moving in the money. Step 2, market makers who sold those calls are forced to buy millions of shares of the underlying common stock just to hedge their books. Step 3, this forced institutional hedging actively outbids the panicked short sellers who are desperately trying to find a way out. It creates this wild, self-feeding upward pressure loop. Finally, Section 5, 3 phases of targets, mapping the squeeze. Real quick, before we reveal these projected targets, if you're finding this breakdown valuable and you want to stay ahead of massive market inefficiencies exactly like this one, take a quick second to drop a like on this explainer and make sure you're subscribed to the Noob Selling Options channel. Your support helps us bring these deep dives straight to you. Okay, let's map out these targets. The analysis projects this whole thing unfolding in 3 distinct phases. Phase 1 is the fundamental re-rate, targeting $145 to $155. This happens as the algorithmic trading models finally update to price in the fact that the $2.9 billion FCC liability is dead and gone. Phase 2 is the NAV arbitrage phase, targeting $170 to $185. This is where that gamma loop kicks in, and market makers begin aggressively buying to hedge those options. Finally, Phase 3 is the parabolic squeeze, pushing up to $210, $240, or maybe even higher. This phase gets triggered when forced broker buy-ins occur, completely exhausting whatever tiny fraction of the available float even remains. Which leaves us with this final thought for the Noob Selling Options community. Given the total elimination of bankruptcy risk, a $49 billion pristine balance sheet, and a violently trapped short interest with basically zero exit liquidity, are we watching a truly historic structural squeeze unfold in real time? I mean, it is a textbook example of what happens when market sentiment severely lags behind mathematical reality. Thank you guys so much for joining me for this explainer. Keep your eyes on the data and happy learning.